Bowman, I think, you look at expectation today, 0.2% month over month. I think that's four good prints. So certainly it would suggest that the Fed's gradual easing path is appropriate. However, they can't declare victory. The fact of the matter is employment is still really, really strong. People really need to tune into your show for non-farm payrolls coming up this coming Friday. And there's still a lot of strength in the data.
Yeah, and that strength is what I'm then beginning to question is, if there is so much strength, why did we need a 50 basis point cut? Why is that sense then still there? Is it really a clear sense that inflation is no longer important, that the PCE data today will ultimately not figure as much then in the big scheme of things because the focus has completely shifted now to employment?
Well, I think you're absolutely right. Employment is now the main focus. However, I think the positioning that Chairman Powell and the Fed have put us on is appropriate so far. And why I say that is I really think when you look at major fundamental components of the economy, most specifically lending, this is a net positive for the corporate debt market, corporate borrowers in general, and kind of keeping that fuel to the fire that is our economic activity. So far, I actually would say that I think they've done a fantastic job and have been appropriately data driven.
Yeah, I always ask the question whether being data-driven meant being data-specific driven or data point-driven, because after every data point, there seemed to have been so much commentary and we didn't know where things were necessarily going. How will we know when we stuck the landing? How long is it going to take before we know that for sure, you think?
I mean, I think it's going to take some time. I mean, obviously, the economy is a living, breathing thing, right? It's not something you could take at a point in time and say, gosh, the victory is won and we're fine. So, when I look at, our overall economic activity, there's no question, PCE, PPI, inflation is coming down. But there's still a lot of things to suggest, like you mentioned, that our economy is incredibly strong. So I think they need to be very patient and deliberate as to their approach.
Neutral look like? I mean, there's this sentiment of let's take it easy until we get to this neutral stance then and this neutral rate. What does neutral actually look like then? Is that something that we predetermine now, or is that going to depend really on many factors? One, if inflation does come up again at a later stage, if employment goes beyond this 4% or 4.2% mark that we've seen and perhaps hits 4.5, is that going to be the key element here? Because debt is still a big factor and spending doesn't seem to be slowing down either.
I think you're absolutely right. I think it's all of the above, and well said. For Palmer Square, obviously we focus on finding the best opportunities in the market, U.S., Europe, corporate credit, structured credit. So wherever the best relative value exists. So it's to be in that position where you have a flexible mandate and an investment process that allows you to move from bonds to loans, investment grade to high yield, structured credit products like CLOs. We really feel like we have an advantage in this environment because, as you said, there's multiple factors. There's no silver bullet that someone could look at and say, okay, that's it. I mean, it really comes down to, as an investor, and if I'm sitting watching the show, which I hope many people are, you've got to have that flexibility because this is a dynamic market right now.